Welcome to the CSBP Fertilisers Grow Better podcast, sharing knowledge with growers on leading crop nutrition, sustainable agriculture and other issues impacting the agricultural industry.
G'day everyone, welcome to another episode of the CSBP Grow Better podcast. My name's Grey Johnston and I'm delighted to be joined today by Greg Easton, Farm Management Consultant at Farmanco. G'day Greg.
Morning, good to be here. And I guess I should give you a bit of background on what I do. So as I said, a farm management consultant, trying to get businesses to improve their productivity, be more profitable and reach their long-term strategic goals. So my client base is sort of from Coorow down to Borden, so quite a long stretch these days. But the advantage of that for me is that not everywhere's having a good year at the same time or a bad year at the same time. So I get a blend of results over the year, which tends to make you feel a bit better when you come out the other end of it.
And how did you get into it, Greg? How long have you been at Farmanco and how did you get into the farm management consulting gig?
I come from a farming background myself. I farmed. I worked in finance for a while, so I was in banking, and I really just wanted to go back and work with rural people. So there was an opportunity at Farmanco as a management consultant, and so I stepped out of finance in about 2007 and have been with Farmanco ever since. So 12, 13 years in this role.
And regular listeners to our show will know we talk a lot about agronomy on the show. And interesting, I think you're sort of more on the farm management business side of the table. Is that right?
Absolutely. So I have to have a broad knowledge of agronomy and production systems, but not the technical day-to-day stuff. And we rely heavily on our agronomists for that day-to-day technical application type roles and also long-term strategic, but we work sort of hand in fist. But ours is more on the business focus, business management, improving business. So we have to understand the grain marketing and production systems and agronomy, but it's not our key role.
And that takes us, I guess, nicely to our first topic of conversation, which is what are you seeing out there as you work with your growers and say, how did last season 2022 finish up?
Yeah, so it's been really good 3 years in agriculture. We've had really good profitability from production and price. And we've also, because of that, we've had businesses are now in the strongest position they've been in a long time. So if you take my client base, for example, I probably had 25% of my client base under pressure 3 years ago. And it's not saying they'd go out the door tomorrow, but they'd struggle to withstand 2 poor seasons. At the moment, I've only got one business in my set that I consider that, and checking with another consultant, he had about the same result. So businesses are broadly as strong as they've ever been and well set up to be able to withstand a challenging year, which is a great result and something we haven't seen for a long time.
And do you see that that shift in business conditions and underlying business position? Do you see that shift in people's decision making? Do you see that driver change in how people are thinking about decisions for the next season?
A little bit, and because this season's started off a bit patchy compared to the last couple, I definitely know some of my northern clients have now dropped paddocks out to fallow, and because the balance sheets are strong and they've got strong cash flows, they're able to do that without any consideration. So there's definitely ability there for clients to adjust quickly to the season that's going on. So those strong balance sheets have made those sort of decisions far easier than they would have been 2-3 years ago.
And some of the other things we've seen in the last couple of years are different changes to tax rules and special concessions from COVID and sort of things like that. Have many of your customers been taking advantage of those sort of things?
We've seen far more new machinery go into businesses in the last couple of years, and I think that's going to be a challenge going forward because I've now seen my first $1 million quote come through for tractors, and it wasn't that long ago that it was like 5-6 years ago that was the first $1 million quote for a header. So the cost of machinery's gone up, but a lot of businesses have taken advantage of that to strategically replace machinery that needed to be replaced probably earlier than they needed to because of the tax rulings. We're going to have a sugar hit here where we sell some machinery later on where there's going to be a capital increase in these sort of things. So that with anything, there's any opportunity, there's always a risk or downside. So it's just making sure that we think about these in the future.
And on machinery and supply chains, I know we had a lot of talk, 12, 18 months of really constrained supply chains and lack of availability in the market. Are you seeing any changes to that?
Not directly at the moment. We're still, like machinery is still 12, 18-month lead times on a lot of it. And same as parts, we're still constrained. And it's also constraining our exports. Like if we haven't got containers or frozen containers, we can't export livestock, those sort of things. So there's some real challenges still sort of washing out through the system. But farm businesses tend to, well, over time, they tend to work things out. And we look at some of the stuff going on now around the Aboriginal Heritage Act and those sort of issues. There's always a raft of those going on at any one time. If we go back, it was COVID, and then we go back and it was weeds were going to be the resistance was going to end us. And that's when I started in consulting. So in the last decade, we weren't going to be able to farm because of resistance, but chemistry's changed, seed destructors in the back of headers, those sort of things have all enabled us to progress and continue to farm profitably. So I think that farmers are generally really good custodians of the land, and they'll make changes to fit within the circumstances.
It's an interesting theme. What other sort of big changes have you seen in the period that you've been in the farm consulting game? What are the things that stand out?
The big one is, I think, a increase in yield. So if we take the last year, in 22, nearly every client achieved above average wheat yields, and some of those were between 10 and 50% above average. Canola not so much because some waterlogging down south impacted. So we've really seen productivity increase dramatically. We're seeing originally when I started, the first thing we'd talk about was lime. So nearly all the clients have got good lime programs in place or done. And now we're starting to see variable rate and those sort of things come in where we're trying to manage costs and further increase productivity, is what the stuff that I'm seeing. Probably, and the same thing that's been going on for generations, farms just continue to get bigger. Like, it's a sad story, but about 2.5% of farmers leave the industry, mostly voluntarily, per annum, and that's continuing. So we're seeing the farmers get bigger. The real challenge at the moment is land prices. When you've got land prices that are potentially trading at, well, they are record high prices, it just makes it difficult for small businesses that need to expand to continue to stay in the game to be able to buy a suitable parcel of land.
But like you said before, I guess there's winners and losers on every side of the equation, and I'm sure that those land prices also contribute to some of those strong balance sheets you talked about.
Absolutely, they do. So broadly, residential housing since about 2001 has grown at about 5% per annum. Farmland has grown at 7% per annum, and we're just finishing up our benchmarking, and I'd be able to tell you what the difference is now, but essentially farmland last year had grown by 7%, housing by 5%, and farm businesses by 11%. So what that says is that farming's actually been a pretty good investment, just owning the land, but the businesses on top of that are generating profits, retaining profits and expanding. And if you can get 11% return out of an investment somewhere, that's a pretty good return. So I guess that shows where farm businesses are at.
And I imagine, you talked about yield improvement before. If you've got an asset that can, through various productivity improvements, yield more, then it makes sense that the value of that asset would continue to increase.
It does, and it's that sort of return. And when we're in a low interest rate environment, which we've been, then the return you need doesn't have to be as high because then you're just trying to beat the interest rate. So with the interest rates increasing, potentially land is not as attractive as it once was, but there's different stuff going on, and there's corporates in the market. BP is rumoured to have bought some land for carbon. So you look at that and go, well, that's just a change in land use, and we've had corporates come and go in the past. Esperance was a largely American corporate-owned area. Now it's majority owned by individuals. There's been English investors in the past prior to that. So corporates come, corporates go. There'll be individual farmers come, and we'll continue to see local landowners, I think, over a long period of time.
And you mentioned before about you're finishing up your benchmarking, and I guess that must be one of the nice things being at a business like Farmanco, where you do have you yourself have a client base that's quite diverse, and then you can roll all that information up to try and unpick some trends. What are the sort of things? What are the other sort of trends you're seeing coming out of that benchmarking work?
Yeah, so look, what we've seen is continued. The live export thing is getting a lot of play, but we've seen a 5% reduction in the number of clients that have run livestock over the last 3 years in a row. So we're still seeing that push towards more cropping intensive businesses. And that makes sense, like and particularly given that we've had challenges with labour over the last 3 or 4 years post-COVID, it makes sense that there'll be pressure under different industries and especially labour-intensive industries. But livestock has a really good fit for the medium and high rainfall and for taking some risk out of it. If we all went to wheat across the board, then we'd have significant disease risk and significant production risk. So the variation of those is pretty important.
And so that risk is, I guess, something that you talk to your growers about when they're deciding on making that decision, whether to keep the livestock in the system or not?
Yeah, absolutely. Because we know in the low rainfall, we can either swap out sheep and have a fallow if we need to, whereas in the medium rainfall, there's areas where we can't produce profitable crops or they're going to struggle. But that's not to say that the livestock will be, in that situation, livestock will be more likely to be profitable enterprise. And so we want to maintain them. It's about thinking about the structure of the enterprise and what it might look like. So in the past, if you've relied on weathers to be your takeoff, so you go, when things get tight, I'm going to sell weathers out of the system to reduce my stocking rate. Well, you can't think like that. So now you're going to have to think about whether I'm going to containment feed, I'm going to store more food, whatever it is to make the sheep enterprise work and give you a safety margin in there. So it's just working on those sort of risks, really.
And you're saying that change is driven by lack of market to sell the product, or driven by the labour requirement to manage them?
Combination of both, I think, at the moment, because we've seen prices fall off. So the sheep enterprise has become less profitable last year than it had in the previous 12 months, but that's an increase in cost because we had a higher feed requirement and a fall in price. And that'd be the same if cereal prices fell and fertiliser prices, for example, went up. It would make cropping less attractive and make a livestock enterprise more profitable, which is why we saw a push in 2022 towards more livestock off the back of 2021.
And you're talking there about, I guess, reasonably season-to-season decision-making. What are some of the other challenges that growers you're working with are talking about when they're thinking about longer horizon decisions for their enterprises?
Yeah, so it's about how they fit in, because what a lot of people would like to fit in more legumes into the system, and some of that is market access at that back end. Like, it's great that we can produce faba beans in the Great Southern, and I think we'd see more produced, but there's a limited market for them. So those sort of things where people, if you're going to have an industry like faba beans or even lupins to a degree, what we see is that people build their own infrastructure to be able to store grain so they can sell it later on. And so we see those sort of issues come to the fore over time as people think about where they want to be, how they want to market their produce, and how they can extract the best value out of it.
And Greg, interesting to hear about what has happened in the last few years and maybe what some of the things you're working with your growers to make decision-making going forward. What then have you been working on this season, and how do you think the season's shaping up so far?
Yeah, the season's it's really patchy. Like, there's some people got really good rains in March, and for those, I was talking to a guy the other day who spent quite a bit of early seeding, pulling tractors out of the bog, and then there's others that are really desperate for rain as we sit here today. And we are getting to a critical juncture where if we don't get some solid rains, then there's going to be some real yield challenges at the back end of the year. Well, what we've seen, I think, is that their program has generally gone in as planned. We've had problems with establishment because of the low levels of rainfall over scattered periods. So we've had some canola establishment problems. We've had some cereal establishment problems, which we haven't had in the last 2 years. But like we know, if it rains in the tail end of the season, that will forgive a lot of sins. But at the moment, for a lot of clients, they're on the edge and waiting for a significant rainfall because they don't have subsoil moisture. They've got crops established, and if we don't see reasonable rainfall, we're going to be struggling to get production, I think.
And the GIWA reports talk about a sort of a reduction in planted area somewhere, 5 to 10% ish. Is that the sort of a figure that you would be seeing across your grower base?
Yeah, for the guys in the northern end of that, definitely. Some guys with about 6,000 to 8,000 program, speaking to those, they've got 1,500 to 2,000 hectares that's stayed out to fallow because it was dry or problematic. So definitely it's in that range, and for those it's run out to fallow at the moment. So and most of the people have finished their seeding programs. Some have finished, and one client in particular has finished and gone deep ripping to try set themselves up for next year. So there's that long-term view about what might be more profitable and trying to do things to set us up for 2023 and beyond.
Yeah, so once all the, I guess it feels like decision making for season 2023 largely complete, then do you get involved with some of those in-season decisions relating to, say, nitrogen application?
Yeah, I do, but not to the same degree as our agronomists would.
Yeah, okay.
So there's definitely that sort of stuff, a bit of a look at historic yields and where we think we might be, and taking that into consideration and trying to come up with a realistic outlook about where yields and price might be, so that if we have got significant nitrogen out or where we think we're on average and we think we're about average, then we can have those discussions. I suspect that we've probably got regular to above average amounts of compound out, given we've had two really big output years in the last 2 years. So people are reluctant to pull back this year on inputs because we've had significant outputs or takeouts in the last couple of years. So we are worried about that nutrient balance.
Yep. And so then what are the other things you're focused on at this time of year?
Right now it's the tax management stuff. Because we've often got grain deferred into July, cash flows get pinched at this time of year and will probably come good in July. So we are looking at the final balance of those, whether we're moving grain into July, whether we're doing it now, trying to get pre-orders on board if we've got opportunities to purchase inputs for next year at good pricing. Those sort of things are what's taking the time up. And interesting enough, there's a couple of property purchases kicking around in July, which traditionally property purchases are probably done December to March, April. They ran all year last year, and it looks like it's going to go potentially all year this year.
Yeah, and do you have a sense of what's driving that?
I think it's a combination of strong balance sheets. Some people have taken the opportunity to retire from farming, and some of it is, I think that's the key part, is that some people are just saying this is a high point in the market and they're thinking about getting out. There's some corporate activity happening as well in that process. So there's opportunities to sell and take your money and do something else if you want to, or it's an opportunity to retire from farming, and so people are always looking for a price. So.
And is there extra due diligence involved, I guess, in doing those property transactions when there's a crop that's been seeded?
Yeah, there is, and I guess that's part of our role, is to make sure that the risk profile that we discuss the risk profile with the client about where they're at, discuss where their financiers might be at, which might be higher or lower than our risk profile, and where the client's risk profile is, which may also be higher or lower than ours. So there's a balancing act there between pushing people to expand and pulling the reins back to make sure that people are in a position that they can withstand a couple of bad years and continue to grow the business. Because we know if we model this stuff, we know in the long run that after a 20 or 30 year period, we'll probably all come out the same. But it's really difficult if you're in a low equity, high risk scenario where your business might fall over any day versus a business that's buying farmland on a regular basis and not have the same degree of risk and management pressure coming on. So some people handle it better than others, and some people don't want any debt at all, and others are happy to take levels of debt that I'm decidedly uncomfortable with.
I guess it's all care, no responsibility in that circumstance then, Greg.
Well, it's not really, because we're long-term clients. We have a long-term relationship with our clients, and though as I'm getting closer to retirement age, you do start to go, well, if you take a 20-year debt, I'm probably not going to see it out. But the problem is if it falls over next year or the year after, you're going to be there trying to find them sources of funding or having really tough decisions and discussions about that. And that is not a pleasant place to be, so I'd rather they weren't there. But that's the nature of the beast, really. We
wanted of our topic of this season. One other thing that came to mind while you were talking about getting product to market was market access and in particular getting grain sold from the last 2 record seasons. How are your growers going with that?
Yeah, they've been chipping away, and we know there's going to be a carry out. So that's going to be challenging because we have, across my client base, we have more grain on hand at the end of this harvest than we did last year that was unsold, whereas last year a lot of it was sold, even if it was sold with July transfer and delivery. So there was more unpriced grain, and we know we've got a carry-out scenario going on. So there will be people that carry grain into next year. So, yeah, it is challenging, and some of those, well, you'd hope that things like China maybe coming back into the barley market might increase pricing there and also turn around some of the supply issues.
Greg, we've had you in at CSBP to talk to our team a couple of times on the sort of issues that we've covered today and provide that nice Farmanco perspective. What else are CSBP and Farmanco working on together, and what do you see as some of the opportunities for our businesses?
Yeah, so it's good to have a collaborative approach, and we really appreciate the fact that we've got James Easton that we can contact as the consultant's contact. So that makes it easy to have one contact point. But where I'd really like to thank CSBP is that we use interns during our review period to help set up our files and take some of the workload off the management consultants. And CSBP provided staff to come and talk to the interns about career advice and career opportunities in ag post their degree. So that sort of tie-in makes it, for me, I think is really beneficial to the industry, because we want young, driven, focused people in the industry, and the more contact they get with different facets of the industry, from agronomy, grain marketing, input suppliers, and ourselves, then the more likely we are to get high-calibre people involved in ag, which is what we need, because it's a rapidly evolving industry and it continues to be more and more technologies coming into that. So we want those sort of people involved.
No, really nice sentiment, Greg. And look, I know at CSBP we're really passionate about also making sure that we get great people in the industry, and we know there can be challenges in doing that. But I think it's great to have a collaborative approach, as you said, and I hope our organisations can continue to work together on those kind of projects. Look, any other kind of key bombshells you're keen to share with our listenership before we get on our way?
No, not really. But one of the key things we are seeing that we probably missed in that little bit was that we're seeing a lot more technology. So the first autonomous tractors and those, the swarm bots in particular, are now in WA. We're seeing a lot more variable rate and precision ag going on. And of course, we're seeing drones flying stuff onto paddocks. So it's an exciting time to be in ag, and like agriculture, it's always changed and developed, and we'll work out some way to make money going forward, because it's an ingenious group of people out there.
And on that bombshell, that'll do us for today on the CSBP Grow Better podcast. Please remember to subscribe, rate and review the podcast, and follow us at CSBP Fertilisers on all your favourite social channels. But until next time, I've been Grey Johnston. Thank you, Greg Easton, for joining us and sharing the Farmanco view of the world.
Thank you, Grey.
See you later, everyone. Goodbye. Ciao.
Thanks for tuning in to another episode of the CSBP Grow Better podcast. For more information about CSBP, please visit csbp-fertilisers.com.au or connect with us on social media at CSBP Fertilisers on Facebook, Twitter, Instagram and LinkedIn.